Most people think they're doing the right things with their money, saving, investing a little, maybe contributing to a 401k. But what if the system you're trusting is already falling behind? What if the numbers you're counting on, your salary, your savings, even your retirement plan, can't keep up with the pace of innovation, especially now as breakthroughs like quantum computing reshape how industries grow and how fast wealth can compound? In this video, Josh and I are breaking down why most people's savings fall short and what's really holding them back, and how 5 quantum stocks could completely change or boost your wealth curve. I'll show you the simple rules for building a smarter portfolio, and by the end, I'll show you how a one-time $10,000 investment in this portfolio could grow into more than $2 million, outpacing the average career income by more than 2 times and nearly 4 times the median American retirement fund. Most people aren't investing to become billionaires. They just want a future that feels secure. But the average retirement savings across America paints a pretty sobering picture. People in their 30s have around $249,000 saved on average. Those in their 50s have roughly $970,000, and even in their 60s, right when retirement is supposed to start, the average balance barely tops $1.1 million. That might sound like a lot at first, but here's the catch. The median savings, what most people truly have, is far lower. In their 30s, it's closer to $91,000. By their 50s, about $441,000, and in their 60s, roughly $539,000. When you look at it that way, it's easy to see why so many people feel like they're falling behind. Now, most people's investments grow about 6 to 8% a year. That's decent, but here's the problem. It's just not fast enough unless you start super early or pour in big contributions every month. Meanwhile, the cost of living keeps sprinting ahead while traditional portfolios jog behind. The result? Even the average retirement plan can leave you feeling like you're running in place. That's where the idea of smarter investing comes in, a tech portfolio designed not just for slow growth, but for compounding acceleration. By blending steady tech leaders and future-focused innovators, you can potentially outpace those averages without taking reckless risks. So, how exactly do we balance those two worlds, safety and innovation, inside one portfolio? Let's talk about why that's even possible in the first place. Technology stocks have always been associated with growth, not dividends. Most tech companies prefer to reinvest their earnings into new projects, research, and acquisitions rather than paying regular income to shareholders. That's why investors usually face a trade-off: either choose slow but steady dividend payers or go for fast-growing tech firms with little to no income returns. However, that line is starting to blur. Some mature technology companies have reached a stage where they generate enough cash to both innovate and reward shareholders. This evolution makes it possible to build a portfolio that combines income stability with high growth potential, a balance once thought impossible in tech. But it also meant a caveat. Tech stocks, which were known for growth, started to grow slowly. And while that's happening on one side of tech, something even bigger is taking shape on the other. A breakthrough that could completely redefine what computing means: quantum technology. Here's the simplest way to think about it. Traditional computers process information using bits, tiny on-off switches that are either a 1 or a 0. Quantum computers use qubits, and here's the wild part. Qubits can be both 1 and 0 at the same time. It's like being able to read every page of a book at once instead of one page at a time. That's why quantum computing has the potential to solve problems so complex that even today's fastest supercomputers would take centuries to handle. Now, the companies working on this, often called quantum stocks, are still in the early chapters of their story. They're volatile, they're experimental, and they're not always profitable yet. But what they represent is pure future. If quantum breakthroughs hit their stride, we could see entire industries flipped on their heads, from cybersecurity and medicine to finance, AI, and beyond. So now, instead of choosing between stability and speculation, investors can actually blend the two: established tech that compounds steadily over time, and next-generation innovators that add explosive potential for the future. It's not about chasing quick wins or collecting dividends, it's about positioning for long-term growth driven by the most powerful force in investing: time, innovation, and compounding working together. Which raises the real question: if we're building a portfolio around those principles, how do we decide which companies actually deserve a spot in it? That's where a clear, disciplined selection process comes in. Selecting the right stocks begins with understanding what makes a company truly valuable over time. The most consistent winners share a few timeless qualities. They generate reliable cash flow, sustain long-term growth, and remain relevant through innovation. These three pillars form the basis for every selection. The first factor is financial discipline. Great companies know how to manage their money. They don't chase trends or overspend. They reinvest wisely, balance growth with stability, and build a foundation strong enough to handle whatever the market throws at them. The second is sustainable growth. This doesn't just mean rapid expansion, but the ability to grow revenues and earnings steadily year after year, adapting to market shifts while maintaining profitability. The third and most defining trait is innovation. In today's economy, businesses that lead in transformative fields like artificial intelligence, cloud computing, or quantum technology are positioned to thrive for decades, not just quarters. Combining these traits, stability, growth, and innovation, identifies companies built for endurance rather than hype. So let's start with the portfolio's foundation. IBM fits that description perfectly. It's not a flashy startup or a momentum stock. It's a century-old innovator that has evolved through multiple technology eras, from mainframes to artificial intelligence, while continuously rewarding its shareholders along the way. Over the past decade, IBM has shifted away from hardware and built its core around hybrid cloud computing, AI, and enterprise software. These businesses generate steady, recurring revenue and provide the kind of predictable earnings that make it a solid long-term anchor. But what makes IBM stand out now is its leadership in quantum computing, a field still flying under most investors' radar. IBM was one of the first major players to develop real quantum systems. Through its IBM Quantum platform, developers and researchers can already access live quantum processors through the cloud. This isn't theory, it's happening today. That access proves IBM isn't just adapting to the next wave of computing, it's helping shape it. Its roadmap for larger, more advanced quantum systems shows a clear intention to stay ahead as the technology matures. Analysts maintain a buy consensus on IBM, with an average 12-month price target of $288.62. The short-term forecast shows a mild dip of about negative 6.6%, but the high estimate of $325 reflects steady confidence in its long-term fundamentals. IBM isn't a momentum stock, it's a compounding one, built for gradual, reliable growth. Financially, IBM's footing is solid. It trades at a PE ratio of 36.97, which is slightly high, meaning investors are willing to pay more for each dollar of its current earnings, a sign of confidence in its stability. Its forward PE of 25.62 is lower, suggesting analysts expect stronger future profits that make the stock more reasonably priced moving forward. The PEG ratio of 3.76 is on the higher side, indicating slower growth relative to its valuation, which is typical for a mature, steady growth company like IBM. IBM's current ratio of 0.93 means it has just slightly fewer short-term assets than its liabilities, a bit tight but manageable for a company with steady cash flow. Its debt-to-equity ratio of 2.38 is on the higher side, showing IBM uses more debt than equity to fund operations, which isn't unusual for large established firms. The interest coverage ratio of 7.58 is strong, meaning IBM earns over 7 times what it needs to cover its debt payments, a healthy buffer that signals solid financial stability. Furthermore, institutional investors hold 61.7% of total shares, reinforcing confidence from large financial institutions seeking predictable returns. IBM also maintains a modest 2.19% dividend yield with a 10-year growth rate of 3.87. It's not about income, it's about stability. That consistency reinforces IBM's reputation as a dependable compounder that rewards patience. Over the past decade, IBM's share price has grown at an average compound annual growth rate, or CAGR, of about 23.5%, reflecting strong performance during its transition from hardware to software and cloud services. Going forward, that pace is expected to moderate. The revised 10-year CAGR projection sits around 18%, which better reflects its current phase, a mature company still expanding through AI, hybrid cloud, and quantum innovation. This 18% rate will serve as our baseline for long-term portfolio projections, representing steady, sustainable compounding rather than rapid, short-lived spikes. This is one of the 5 quantum stocks I have for today's portfolio. In a couple of minutes, I'll show you the complete lineup of quantum stocks, and in the end, I'll show you how a one-time $10,000 investment in that portfolio could grow into more than $2 million, outpacing the average career income by over 2 times and nearly 4 times the median American retirement fund. But first, let's look at a company that takes that same foundation of reliability from IBM and adds a massive dose of innovation. Microsoft is one of them. It combines the dependability of a dividend payer with the high-octane growth of a technology leader, a rare blend that allows it to perform well in almost any market condition. Microsoft's business model has evolved into a diversified ecosystem that touches every layer of modern technology. Its core strength lies in enterprise software and cloud computing, with Azure now serving as one of the largest cloud platforms in the world. Alongside Office 365, LinkedIn, and its expanding AI integration, Microsoft generates recurring revenue streams that make its earnings both predictable and scalable. Analysts remain confident in its future. Out of 45 ratings, Microsoft holds a strong buy consensus with an average 12-month target of $633.06, implying about a 25% upside from current levels. The most bullish forecasts go as high as $700, reflecting strong faith in Microsoft's continued growth, disciplined execution, and leading role in artificial intelligence. From a valuation standpoint, Microsoft trades at a PE ratio of 35.99, meaning investors are willing to pay about 36 times its earnings. High, but typical for a market leader with consistent profitability. Its forward PE of 30.38 suggests future earnings are expected to grow enough to make the stock slightly cheaper over time. The PEG ratio of 2.26 shows that while it's priced at a premium, its growth rate largely justifies that valuation. Its price to free cash flow ratio of 48.2 also signals strong investor confidence. The market is willing to pay more because Microsoft's cash generation is both predictable and massive. Financially, the company is about as strong as it gets. A current ratio of 1.4 means it has comfortably more short-term assets than liabilities, and a debt-to-equity ratio of 0.33 shows it uses very little debt compared to its overall equity base, an extremely conservative setup. Its interest coverage ratio of 53.56 is excellent, meaning it earns over 50 times what it needs to cover debt payments. Institutional ownership sits at 71.51%, among the highest in the market. That level of institutional confidence typically signals a long-term view of stability, growth, and disciplined management. Looking at performance, Microsoft stock has averaged an annual growth rate of 24.96% over the past decade. For future projections, that's being adjusted to a more realistic 19% CAGR, reflecting its maturity as a global leader. It's no longer in hyper-growth mode, but it continues to expand through AI integration, cloud dominance, and recurring enterprise contracts. That balance between dependable execution and constant innovation makes Microsoft one of the most powerful long-term compounding engines in tech. Now let's add some explosive options to the portfolio, companies built for pure acceleration. NVIDIA is exactly that. It's gone from building graphics cards to becoming the backbone of data centers, artificial intelligence, autonomous vehicles, and even parts of quantum research. Its GPUs are now the engines driving how modern computing actually works. Analysts rate NVIDIA a strong buy, with an average 12-month price target of $217.93, pointing to a 9.49% upside from current levels. The lowest target is $100, while the highest reaches $350, showing a wide range of opinions, but overall confidence in NVIDIA's long-term strength remains strong. Most analysts agree that the company's leadership in AI infrastructure and data processing will keep driving growth well beyond the short-term forecasts. NVIDIA's PE ratio of 56.7 is high. The forward PE of 34.29 shows profits are expected to expand fast, making the valuation more reasonable ahead. Its PEG ratio of 1.04 suggests that growth keeps pace with its price, a healthy balance for a high-growth company. The price-to-sales ratio of 29.47 and price-to-free cash flow ratio of 67.16 are elevated, reflecting strong demand for its technology and high expectations for continued profitability. Financially, NVIDIA is exceptionally stable. A current ratio of 4.21 shows it has more than enough short-term assets to cover obligations, while a debt-to-equity ratio of 0.11 means minimal leverage. Its interest coverage ratio of 390.16 confirms it easily handles debt, giving it flexibility to keep investing heavily in R&D. Institutional investors hold approximately 66.66% of NVIDIA shares, signaling strong long-term confidence. When it comes to dividends, NVIDIA isn't built for income. Its 0.02% yield is mostly symbolic. Historically, NVIDIA stock has compounded at an astonishing 73.3% per year, driven by explosive demands for GPUs and AI hardware. Going forward, we'll use a more realistic 22.5% CAGR for projections. This adjustment accounts for its larger market capitalization, the natural slowdown that comes with scale, and a higher valuation base that leaves less room for outsized percentage gains. It's not a downgrade, it's a sustainable expectation for a company that's already a global leader in next-generation computing. We've seen today's leaders, now let's look at the future, the world of quantum computing. Two early leaders stand out, Rigetti Computing and IonQ. Both are high-risk, high-potential innovators still in their early stages, but their work represents the future of computing, the bold side of long-term growth. Founded in 2013, Rigetti Computing is one of the few pure-play quantum companies listed in the US. Its focus is building quantum-integrated circuits, the processors that power quantum systems, and developing hybrid models that combine quantum and classical computing. This hybrid approach could make quantum technology usable sooner by bridging today's hardware with tomorrow's potential. For an early-stage company, Rigetti's financial position is surprisingly stable. Its current ratio of 39.22 means it holds over 39 times more short-term assets than liabilities, an unusually strong liquidity cushion. A debt-to-equity ratio of 0.02 shows it operates with almost no debt, allowing it to fund R&D without relying heavily on outside capital. That financial flexibility is rare in deep tech startups. Analysts maintain a strong buy rating on Rigetti, with an average 12-month price target of $27.40. The projections range from a low of $12 to a high of $50, reflecting both the volatility and the massive upside potential that comes with breakthrough technology. The short-term forecast includes downside risk of about 17%, but the high-end estimates suggest possible gains above 50%, typical for early innovators in frontier fields. Rigetti's valuation numbers look extreme, a PS ratio of 1,456.8, forward PS of 833.7, and PB of 28.94. But that's normal for pre-revenue tech companies. Investors here aren't buying today's earnings, they're buying the potential to lead an entire new industry. Ownership is balanced, with 43.4% institutional and 54.9% public shareholders. That mix shows both professional and retail investors share confidence in its long-term potential. Rigetti doesn't pay dividends. Every dollar goes into development and scaling. Historically, the stock's annual appreciation has averaged 31.35%, showing how much excitement this sector attracts. For projections, we'll use a more conservative 17.5% CAGR to account for volatility, competition, and the long road to commercialization. Now let's look at IonQ, another quantum pioneer. It represents the commercial face of quantum computing. It was one of the first pure-play quantum companies to go public, and unlike most in the field, it has already started monetizing its technology. Through partnerships with Amazon Web Services, Microsoft Azure, and Google Cloud, IonQ provides on-demand access to its quantum processors via the cloud, meaning customers can already run quantum algorithms remotely. IonQ's technology is based on trapped ion quantum computing, which uses charged atoms suspended in electromagnetic fields. This method is known for its high precision, scalability, and low error rates, giving it an edge in accuracy over some other quantum approaches. Analysts remain strongly bullish. IonQ holds a strong buy consensus with an average 12-month price target of $66.64, a projected 20.35% upside from current levels. The high estimate of $100 suggests potential gains of up to 80%, while the low target of $30 shows that volatility remains part of the story. Overall, sentiment points to confidence in its leadership position within the quantum space. Financially, IonQ is in excellent shape for an early-stage company. Its current ratio of 8.73 means it has nearly 9 times more short-term assets than liabilities, strong liquidity for ongoing R&D. A debt-to-equity ratio of 0.01 indicates virtually no debt, giving it the flexibility to expand without heavy borrowing. Valuation ratios are high but expected for a company defining a new industry. A PS ratio of 172.17 and a forward PS of 124.09 reflect investor optimism about future growth, while a PB ratio of 7.92 suggests the market is pricing in significant technological potential rather than near-term profits. Ownership is well distributed, with 36.16% institutional and 61.99% public shareholders. Also, IonQ doesn't currently offer a dividend yield, as it remains focused on reinvestment and scaling its quantum computing operations. Historically, the company's share price has grown rapidly, averaging around 34%, but for long-term projections, a 20.5% CAGR is more realistic. That rate reflects the transition from speculative startup to structured revenue-generating enterprise, still aggressive, but sustainable for a leader in quantum commercialization. Together, Rigetti and IonQ form the forward-looking side of this portfolio, high-risk, high-upside innovators driving the next leap in computing and AI. With all 5 quantum stocks in place, let's see how the full portfolio comes together by the numbers. Across the board, the portfolio averages a dividend yield of 0.59% and a 10-year dividend growth rate of 6.03%, mostly driven by IBM and Microsoft. That yield isn't meant for income, it's simply the byproduct of mature companies that generate reliable cash flow while still reinvesting in growth. The bigger story lies in appreciation. The portfolio's average projected annual growth rate sits around 19.5%, combining the strength of proven performers with a long runway of emerging technologies. Numbers alone don't tell the full story though. The real impact shows up when time, patience, and compounding start working together. Let's see what this portfolio could become over the long run. Let's say Josh invests $10,000 into this portfolio and simply lets it grow for 30 years. In the first year, the investment is projected to be around $12,000, marking the early stages of compounding. By year 10, the portfolio is expected to grow to roughly $61,000 as compounded gains start to build momentum. By year 20, the balance is forecasted to reach nearly $365,000, showing how compounding begins to accelerate once growth feeds on itself. And by year 30, the portfolio is projected to be valued at around $2.17 million, turning a modest $10,000 starting amount into substantial long-term wealth. To put that into perspective, the average American entering their 60s has about $1.14 million saved for retirement, while the median saver holds closer to $539,000. This portfolio would deliver roughly double the average and 4 times the median, all starting from just 10 grand. Want to know how much investment in SCHD you'd need for $5,000 a month? Click the video on screen to find out.